All right, welcome everyone. I have 1 o'clock Pacific, top of the hour, so we'll go ahead and get started. Thanks to everybody for joining in. This is our second 2310 monthly educational webcast, where we try to cover 23 minutes of a financial educational topic and then do 10 minutes of live Q&A. Today's topic is it time to worry about inflation? So we're going to get into that here in a bit. Before we do that, just a few logistics here. So first of all, Q&A is encouraged both when you register and you can submit your questions live throughout this, and we'll hit them at the end. There is a Q&A function in your Zoom controls. So if you simply type in a question there, I'll try to make sure to hit those and keep them coming throughout the presentation, and we'll hit them at the end. The other thing that I'll mention is this is episode 2. This is our second time doing it. So we would love feedback, what works, what doesn't, what topics you'd like to see us cover and address here. Love to see those ideas. So send them in. We did get several after last one and in the months between, and that's why we're talking about inflation today. So definitely send those in, and we'll try to address them. Either send them in the Q&A or simply reply to the invitation you received to sign up for this, and we'll get that message as well. So, or send them to me directly if you have my email, that works too. So with all that said, let's get into it. So agenda for today, we're gonna spend, again, 23 minutes on our topic. We're gonna talk about inflation. We're gonna start by talking a little bit about the markets and the economy, just where we are today, kind of level set it. We're going to get into the role of the Fed in all this. We're going to talk about what actually drives inflation, and then some investing considerations. And then again, we'll leave time at the end for some Q&A. So let's jump into it. Year to date, we're looking at, this is the S&P 500 index, probably the index that most people are tracking and following. US 500 largest companies here in the US. 34% drop from the all-time record peak on February 19th, down 34% to the bottom in March, and then we've rebounded about 38% since then. So all in, that leaves us about 9% down from that peak in February, and leaves us about 5% down, at least on the S&P 500 for the year. Now, in terms of how that compares to prior markets, we've looked at this before, but I think it's worth remembering. That drop, 34%, is basically right in line with an average bear market. The average bear market going back to 1950 is a 35% drop. So pretty much right in line with that. And in terms of the rebound that we've seen since then, we've seen a strong bounce back. Again, that's fairly typical, 1 year, 3 years, 5 years later. You would expect the markets to bounce back pretty hard after a bear market drop. What's unusual about this year? I mean, there's quite a few things that are unusual about 2020, but from a market perspective, what's unusual is the speed of the decline. Is kind of the fastest bear market on history, and the speed of the recovery. We bounced back very hard in the first month, and so the magnitude of the drop or the rebound has not been unusual. Just the speed in which it has happened has been a bit unusual. So what is the market reacting to? Really, it's two things: health concerns and what's going on there with the coronavirus, the COVID crisis, and what's the economy? What kind of shape is the economy in? So I'm not going to go into this in a bunch of detail, but I think the market's paying attention to these things, and this is a couple of things we're looking at. So one is just the health data. So obviously, if you've been paying attention to the news lately, we've seen a spike in cases, and those numbers are eclipsing the peak from late March, early April. So obviously, that's driving some nervousness across the board, in addition to in the stock market. And you're seeing the stock market react to some of these spikes in cases across different states. And in aggregate, what we're looking at here is in the United States. What's interesting is on the right here so on the left is daily confirmed cases, and this is a 3-day rolling average. You can see that there's some spikes and drops in this, and there's some, basically seasonality or daily variation in this data. Some testing is run on different days, and so you'll see the spikes day to day. A true 7-day average would probably smooth a lot of that out. The week to week variation is not available in this source. So we're looking at a 3-day rolling average. Again, on the left is cases, which you've seen a big spike in. On the right is deaths. And we've seen, a spike in the last week. However, if you look closely, kind of the lows are in line or even lower than basically this declining trend line here on deaths. So, what's happening on the left, obviously this is not good news. On the right, this is better news. The trend is down, and the market is kind of weighing both of these things. Now, who knows? I mean, the deaths are obviously going to lag the number of cases, and so remains to be seen if we get a spike lagging this spike over here. But there could be other things going on as well, right? So medical professionals getting better at treating it. We could be picking up more cases, more confirmed cases, whereas in the past we weren't doing as frequent of testing. Younger people are testing positive for this at higher rates, which it looks like they're not as affected as much. And so a lot of things going on, but this is kind of what the market's trying to suss out. How big of an impact is the health crisis going to be on the economy? And obviously it does affect it. The other thing the market's paying attention to is just the economic data that's coming out. Here you're looking at a chart, Citigroup Economic Surprise Index. Don't get lost in this, a bit of a busy chart, but basically think about it this way. If the line is above 0, it means the economic data is coming in better than expected or better than the consensus out there. It doesn't mean the data is good or bad. It just means the data is coming in better than expected. So if we're below 0, data is coming in worse than expected. Above 0, data is coming in better than expected. And what you can see is the last reading, this is from June 24th, is basically off the charts in terms of the date range here, going back to 2009. It's 160 essentially over 0. And so data is coming in a lot better than expected. And this is going to be beneficial to the market. If what's priced in is the consensus, and if the numbers come in and beat the consensus, that's basically good news for the market. Whether or not the number in absolute terms is a good number. If we're reporting another 3 million people file for unemployment, that's not a good number. But if the market's expecting 5 million and it comes in at 3 million, that from a market perspective, that's good news based on what's priced in. The other thing to consider in all this on the economic data perspective is the bar is getting higher. So you can tell this line is mean reverting. It goes, it's above 0, and then it goes below 0, and above 0, and below 0. Expectations get reset. And so these are consensuses out there. As news comes in, as data comes in that's better, the bar gets higher, and it's harder then to have a surprise. And so the bar has been set very low for economic data over the past month. That bar is now getting higher. And so expect, I would say, probably less surprises going forward, less upside surprises. Anyway, now, obviously none of this is a forecast or expectations. A lot of this is the economic forecasting is very hard to pin down and definitely above my pay grade, but it's worth paying attention to, I think, in aggregate, what the market is paying attention to, which again is the health data and how the economic data is coming in. The other thing that's worth a reminder, I believe, and we've covered this before, is the market is going to react to, or it's more correlated to, what the future growth of the economy is. So growth next year versus what's actually happening today. So kind of one of the questions we get is, the economic data is terrible right now. How is the market going up? And again, the market's kind of paying attention to what's the expectation for GDP next year versus where is it today. So really quick, 2 charts. The chart on the left is GDP growth correlated to what the market's doing in the current year, which you see really no relationship, a flat line, versus what the market is doing and what's GDP going to do next year. So that's basically impossible to forecast where it's going to be, but the market is more correlated to what the expectation is or what actually GDP growth is next year. And there you see a positive a line that's sloping up and positive. Now, obviously this is not perfect, but it's more indicative of what the markets are doing now, what the economy is doing next year. And that's kind of one of the reasons why we can have some bad economic data, but the markets have still gone up. So that's a brief kind of recap of where we are today. Let's get into inflation. So here we're going to basically our topic of the month is it time to worry about inflation? So we want to look at, again, the role of the Fed, what's driving inflation, and then some investment considerations for investing in an inflationary environment or an environment that's not set up for inflation. So first thing here is the role of the Federal Reserve. They have what's called a dual mandate of two things. Price stability is one side of this teeter-totter that they're trying to balance. The other side is maximum employment, or a minimal unemployment, if you want to think about it that way. So on one side of this equation, essentially, that they're trying to balance is stable prices, low inflation, and the other side is maximal employment. Price stability is important because from a long-term planning perspective, whether you're running a business or just running your household, it's important to know or have some degree of confidence what prices are going to be, not this year, not only this year, but next year and a few years into the future. If you have no idea where prices are going to be, it becomes really hard to plan for the future. And that's one of the reasons that this price stability is so important. It allows businesses and the economy to make long-term plans and kind of know where things are going to be within a reasonable range of expectations. And obviously, employment is beneficial for a host of reasons, but it's obviously very beneficial to GDP growing over time. So those are the two things that the Federal Reserve's trying to mandate. They have some very specific targets for this. So here what we're looking at is they provide an outlook or a range of forecasts over the next 3 years, and then in the longer run, on the unemployment front, which is the top chart that we're looking at, their long-term goal or their stated goal is 4% unemployment. So that's considered basically full employment. You're always going to have some level of unemployment, people between jobs and things like that, but 4% is their target for unemployment. On the inflation side, their target there is 2%. That's what they're targeting as stable inflation rate that they'd like to see. They're agnostic, essentially, whether it's 3% or 1%. Either of those are equally as good. They'd like to get to 2, but they're okay with it being a little bit above or a little bit below. So in other words, inflation's low now, around 1%. They just as well see 3% as they would 1%. Either side of that 2% is okay. Whereas with unemployment, 6% is not as good as 2%. They'd rather see that one lower. So this is what they're targeting. In terms of their forecasts, basically you see their range of forecasts, and the red is the median forecast. So what they're forecasting is in 2020, unemployment to be about 9% by the end of the year. 2021, we're moving down to 4% or 5%, excuse me, a little bit over, and then still a little bit over 4% out to 2022. On the inflation front, you see it basically forecasted to be below 1% at the end of this year, 1 point something next year, and then getting closer to 2 after that. So what this tells me, and what the Fed has actually said, is they're more concerned with driving this unemployment down than they are about inflation. Inflation's already below their target. They'd like to see that come up. Unemployment is above the target, and they need that to go down. This one's further away from the target than this one. The actions that they're going to take are potentially going to be inflationary. They're more concerned with driving this down. And I mean, that bears out if you look at their balance sheet. So the Federal Reserve's balance sheet is ballooned to over $7 trillion in 2020. If you look back, you can see a spike in 2008 where it essentially doubled. This is their reaction to the global financial crisis. Went from about $1 trillion to over $2 trillion. And that's the balance sheet. That's one component of the actions that they've taken. Another is their zero interest rate policy. And then Congress has acted as well with about $3 trillion of fiscal stimulus. So this is the CARES Act and unemployment benefits and all those packages. So, all this leads people to, the question of, well, should we start getting worried about inflation? So there is a couple things to consider here. So one, just increasing fiscal stimulus, the Fed's balance sheet, reducing interest rates to zero doesn't necessarily cause inflation all by itself. There's some other things to consider. A couple of them here are output gap, which we're going to go through, but it's basically, is the potential for the economy running above what the actual output of the economy is? And if so, that is not necessarily inflationary. Demographics, the older the population of a country, the less inflationary pressures that country is going to have, which we're in a situation in the US and really a lot of the developed world where demographics are getting older. And so that's inherently a non-inflationary kind of situation. Commodity prices, high commodity prices tend to be a contributor to inflation. We're not in a situation where we have high commodity prices now. A strong dollar, or really the currency of the home country, the stronger your currency is, the less inflationary pressure you're going to have. You can import things, you can buy things from overseas, including commodities, for less money, and the prices aren't necessarily rising as your currency is strong. So that's going to be sort of a headwind to inflation. And then stagnant wages. Wages are a big contributor to inflation, and we've seen some pretty stagnant wage growth over the recent past, and that's one additional headwind to inflation. Now, is that caused by globalization or other factors? I don't know. That's a big debate, but stagnant wages certainly is another headwind out there for inflation. So just the Fed and Congress acting with a bunch of money added to the economy doesn't necessarily or isn't necessarily going to lead to inflation. So we need a few things for inflation to happen. We need banks to lend the money, we need corporations to invest the money, and we need consumers to spend the money. All those things are needed to drive inflation. So let's dive into some of these different factors and essentially just look at some data on where we are. The first thing that we want to look at is that output gap that I mentioned. So here we're looking at basically the yellow line there is the potential GDP of the US or of any economy. What can the economy produce? And then the blue line is either the forecast or the actual GDP of the US. When the blue line is above the yellow line, that's essentially an output gap, meaning the economy can produce more than it's actually producing right now. And if the blue line's below the yellow line, that is a non-inflationary kind of environment. And so to give you an example, imagine a car manufacturing facility. If they have the potential to produce 1 million cars, but the demand for cars are 800,000, the supply exceeds demand, and therefore that's not an inflationary environment. They're going to want to run the plant at capacity, which puts a damper on prices. Now, this goes on long enough, obviously they're going to shut down capacity, and the potential GDP of the country would actually fall. But in the short run, it's kind of a non-inflationary or a deflationary environment. And this is exactly what we saw back in 2008 in that recession. We were just starting to see this gap close and starting to see wages go up and some inflationary pressures before we hit 2020. Other thing to consider here is consumer expectations. So the University of Michigan does a survey every month of consumer expectations for inflation, and we've really seen this drop. And why this is important is, again, think about consumer behavior. And if you're going to buy a car in the next 3 months or 6 months, or you're planning on buying a car now, but you're kind of indifferent whether you need it in 3 months or 6 months, you're going to upgrade. If you're expecting prices to fall, you're going to be, you're not certainly going to be in a hurry, and you might rather wait to see if prices actually fall. And so again, if expectations are for prices to drop among consumers, they're not going to be in a hurry to spend the money, which is, again, kind of a non-inflationary environment or scenario. Other things to look at: personal savings rate. We've seen this spike. Again, if people are saving the money, not spending it, that's not inflationary behavior. We saw similar spike in 2008 in that recession, which makes some sense. The strong dollar. Again, if your currency is strong, there's some headwinds against inflation there. And so this is a chart of the US dollar versus its major trading partners across the globe. We've seen a very strong dollar since 2016, essentially, seen the dollar go up. In 2008, in that recession, we saw the dollar strengthen, weaken after, and then recently strengthen. So again, this is going to go through cycles, but one of the main things right now, or a big thing that's kind of preventing inflation, is a strong dollar. To the extent that we see the dollar weaken down the road, that could be some fuel for inflation. But that's definitely one thing to pay attention to. All this kind of translating into market information or market data. Here we're looking at the actual inflation rate in blue against the 10-year break-even inflation rate, which is kind of what the market is expecting. So here, what you're doing is taking the inflation protected security, a treasury inflation protected security versus a regular treasury bond. And it's basically how much are you getting paid above a certain level. And so what you can see here is right now, that rate or what you're getting paid is about 1.5%. So if inflation is above 1.5%, it's better to own the inflation protected security. If inflation over the next 10 years, we're looking at 10 years out, if inflation over the next 10 years is below that amount, you'd actually be better off just buying the non-inflation protected security. So that's kind of where the market is expecting it. Out to 10 years, the Fed has taken a lot of actions. However, there are these headwinds that we kind of went through to inflation. And so the market's expecting inflation even 10 years out, actually below the Fed's target of 2%. They're expecting, one and change over the next 10 years. One other question though that does come up is, well, what about debt? The country has issued a bunch of debt, and how concerned should we be there? This is a chart that shows the World War II period. So this is kind of a similar period where Fed kept the rates low to balance the budget as funding World War II. The country issued a lot of debt to pay for World War II. What did that do to inflation? And basically, it took a long time, even though the debt was at a similar level in terms of percentage of GDP back then as it is today. It still took a lot of time, and even with kind of the manufacturing capacity limited here in the U.S. and a lot of people getting back to work and a fairly strong economy, it still took a while for rates on bonds to rebound, about 18 years in this period, back where they were previously. So again, it's basically not a foregone conclusion, even if you have a similar setup in terms of debt and low rates, that it's going to necessarily translate immediately into inflation. One other question that we got in advance of this webinar, and thanks for sending that in, is, well, okay, so if the Fed does get inflation like they're trying to do, and it gets out of control, what can they actually do to bring that back in line? Really, the main tool at their disposal is control of rates. And so here, what we're looking at is the 70s and early 80s. This is a period of very high inflation. And this is exactly what they did in this period, is they ramped up rates. This is in blue, to over 20% here in the late 80s, and all in an effort to bring down inflation. So the Fed was trying to balance kind of two things, those two things we talked about: unemployment, getting the economy to grow, and inflation. They decided after a period of fairly high inflation and really kind of stagnant economy, this is a stagflationary environment is what they called it, that more important to control inflation. And so they really got on the rates and raised those rates up to 20%. And you can see had a pretty drastic impact, basically crushed inflation on that period, and had a good setup for the economy basically going forward into the 80s and 90s. So that's the main tool in their disposal, is increasing rates, slowing the economy, and bringing down inflation that way. Now we're running a little bit short on time, and I want to make sure to get to this last piece before we get into the Q&A. Given all this, I think, kind of the outlook for what a lot of people are saying is, yes, there's been a lot of actions taken that could be inflationary, but there's also a lot of headwinds. And so right now, kind of in the short term, medium term, actually deflation or lack of inflation is probably the bigger concern. That's certainly what the Fed is targeting as being more concerning. Long term, maybe we do get inflation or longer term, but how do you think about investing in those different environments? So you're looking at basically a quadrant here of 4 different scenarios. You can have growth of the economy, and you can have inflation or disinflation, deflation on the other side. So you can have kind of 4 different scenarios. You can have inflation with growth, you can have inflation without growth. And what tends to work under those different scenarios? You can see the graphic here, but what I would focus on is basically inflation, deflation. In an inflationary environment, some of the assets that are going to do better, at least on a relative basis, none of this is absolute. You could have everything be up. Foreign stocks and US stocks all be up. But one, at least looking back over history, is going to do better than the other in different environments. And so in an inflationary environment, cash is actually going to do okay because it's very short duration. The interest rates are going to get updated as rates go up. Your cash is going to go up. You're not locked in at low rates for a long time. Tips, these are just inflation protected securities. Pretty straightforward there. Commodities tend to do well in an inflationary environment. The prices of commodities go up. And then foreign stocks tend to do better than US stocks. And again, this is driven a large part by the dollar either increasing, getting stronger, or declining. In an inflationary environment, oftentimes the dollar is weakening, and therefore foreign stocks relatively look better because of that currency discrepancy. Essentially the opposite in a deflationary environment. The long-term bonds, you locked in a bond at 2% and you have some deflation. Now that's a good thing. Corporate bonds, same thing, and US equities. And again, that's kind of driven by the dollar. So those are just some considerations. I'm sure if you're a client, you work with us, or if you know anything about us, the key here is to be set up under different scenarios. Nobody can predict. It seems a lot of people are thinking inflation is not something that we need to worry about today, but that's not to say we couldn't get a surprise. And so having at least part of your portfolio that's set up to help you in these different environments is important. And two, not having a full-on hedge where if you don't get the scenario you're looking for, you lose money. We would expect, or we're going to build a portfolio that has things in there that are going to work better in an inflationary environment, things that are going to work better in a low inflation or a disinflationary environment. But all those things should be expected to make money over the long run, whether or not you get that scenario or not. It's just on a relative basis what might help you more or less in that environment. So that's it. Just a quick summary here, and then we'll get to the Q&A here. In terms of inflation, yes, money supply has increased massively. That doesn't mean, based on some of those headwinds that we looked at, that inflation is inevitable. And that lastly, kind of preparation is better than prediction. We don't know which scenario we're going to get. Things could be different this time, even if we look at all the economic data, history, and say, oh, we really think this scenario is going to play out. Things could be different. And so preparation, being aware of how different investments work in different environments and building a portfolio that's robust to those different environments is better than trying to predict one and kind of bet the farm on one scenario. So that's the summary. Let's get to some Q&A. We've got a couple of questions submitted here, so let me get over to those. So first question here is there motivation for the US to inflate away our debt? So again, I encourage you, we have another about 5 minutes, so submit some more questions if you have those, and we'll get to those. But for this first question, answer is yes. I think countries across the world have more debt, and this is why the Fed has a target of 2% inflation versus 0 or -2. There's definitely just the way society is set up. There's definitely a need or a want or a desire to inflate away the debt. It makes it more palatable across the board for countries, for companies, for individuals. I think anybody would rather see wages going up and incomes going up, and it makes it easier to pay debt off over time. Who this hurts? This hurts the people that own the debt, right? So if you have money in bonds and you see high inflation, that's definitely a scenario that's less beneficial than falling or stable prices. And so again, this is why, build it from a portfolio construction perspective, it's helpful to have some of both, right? Bonds are going to be very helpful from a stability perspective, but if we get growth, inflation, things like that, they're not going to hold up as well. So yes, there's motivation to do this. I would say though, it's not as easy as it seems. The Fed can't snap their fingers and have inflation inflate away the debt. Japan has been trying to do this for 20 years or so. They have high debt relative to GDP. They had, a massive bubble that popped in the late 90s, or sorry, the late 80s, early 90s. And they've been essentially begging for inflation, and they can't get it because there's some of these other headwinds. So I would say yes, some form of inflation. Maybe they'd rather have 3% than 2%, but it's not as easy as just sort of snapping their fingers and making it happen. Any other questions? Okay, so we're getting one question about gold and why the price has been going up. And I would say on the gold front, I'm far from an expert on gold. Gold is kind of an interesting case study here because there's kind of two components to gold. So one is just sort of a store of value or a hedge, kind of like the US dollar or cash, but people sometimes use it as a hedge instrument, kind of a flight to quality in recessionary environments. The other is it's actually a commodity. It's used as an input in certain things. I mean, it's used for jewelry and other electrical manufacturing components and things like that. So there's kind of a two-part to it. So I think the answer is, some people obviously are concerned. Oftentimes gold is used as a hedge for inflation. There's obviously some concern there in a recession or a market drop. There's some of a flight to quality there. But if you look kind of long term, gold isn't necessarily an income producing or a cash flow producing asset. So for us, it falls into that commodity bucket where, yes, in some of the commodity exposure we have, maybe it makes sense to hold as sort of this hedge against inflation, but long term, it's not like stocks or something like that where you would expect a big growth component. You're not seeing earnings or anything like that from it. So I guess conclusion here is don't know exactly why gold's been going up, but kind of historically, the two scenarios that people tend to look to gold or buy more gold are when there are some concerns about inflation, which there are now. However, that is going to conflict with if we looked at the TIPS data, right? On average, the market's expecting actually inflation out 10 years that it's below the Fed's target. That would be one. And then the other is just in an environment like this, a recession and market drop, as gold tends to be kind of the safe haven that people go to as well. So good question. We've got a couple minutes, at least one more minute here to stay true to our 23:10 time limit here. Don't have any questions, so I guess we'll go ahead and end it there. I will thank everybody for coming, attending, watching this, spending your time. I know that there's going to be some that watch this on replay. So for anybody either watching this live or watching it on replay, there is a resource page. Essentially, we're just going to post the video here, and there's a form on the page where you can subscribe to make sure to be updated on any future episodes. We're trying to do these monthly. And if you are a client and you want to discuss anything that we talked about today, definitely reach out to either me or one of the Scotts, and we'd be happy to chat more. If you're not a client and you want to get in touch, or if you have some questions, there is a form on this page as well where you can get in touch. So that's it. Hope it's helpful, and thanks everybody for attending, and have a good afternoon. Bye.